Today it's raining outside, so I am inside in front of my computer, and I thought I would take this opportunity to walk through with you how to build a very basic system, accounting system in Excel. This is a system I've used when I've set up basic accounting systems for, say, side businesses for individuals or very small kind of startup nonprofits or startup family businesses or individual businesses where they're just getting started. They're trying to track the money coming in, money going out. There's not a lot of transactions, usually in the range of, say, 50, maybe 100, 200 transactions a month, but really low in terms of number of transactions, which can easily be managed in Excel. And because they're startups or they're nonprofits or it's just an individual with some with a side business, they're not looking at spending even $150 or $200 on a out-of-the-box accounting system. And I would argue at that level and at that stage in a business, it probably doesn't make sense to pour the amount of time you would need to set up one of those systems to do what you need, what they would want it to do. You would end up putting a lot of time to basically reduce the functionality of that system to something where they're just tracking cash inflows and outflows and maybe a little bit of assets on an ongoing basis. So I'll show you how I generally set that up, and hopefully it's helpful for some people. Start by opening up Excel. Once Excel is opened, we're going to rename this tab by double-clicking on it. We're going to call this tab Transactions. Now, you can typically start in, say, the first row. Let's see, we want to start with the date. We'll do April, but we're going to, we'll just type in date. Once we have the date set, let's type in the description. These are going to be our main columns. And I think I'm going to want to move this. Let's move these down and give us the first row empty so that we can give categories to our assets, like to our accounts, like assets. So within assets, we have cash, receivables. We'll put inventory. I don't think I'm going to use it. Equipment, and then we'll have some liabilities in here. We'll just call this the equipment loan for now. And we'll put in our equity account, which we're just going to assume basically kind of like a sole proprietorship or small side business. So that's our just generic equity account. We have our revenue and expenses. We'll have a basic sales account, just one. And then we'll use maintenance expense for the time being. And then also just an other. I'm not sure what expenses we're going to have yet. I haven't developed the company. So give room for the description, spread everything out. We'll center the assets over, just merge those cells so that it kind of centers out over those areas. And then let's put some other formatting up here. We'll center across the area and then put a line under the cells, so that sets it apart a little bit. There we go. I'll also put a line under date and description as well. So we're going to start off with our transactions. As I mentioned before, we'll do April 2020, although I probably won't worry about the year at this point, but oh, that's right. In Excel, you have to put the year or it'll mess up the dates. So I'll do April 1st of 2020. I'm going to start by funding this organization. So start company. We're going to fund it with $500 of cash, and we're going to do a lawn mowing or yard service company, and we'll start with, say, a lawnmower that we're going to value at $1,000. So that gives us two assets worth $1,500. That gives us equity of $1,500. Now, if you know debits and credits, all the credits are going to be negative numbers. That's why equity is a negative number. And that way, I can sum across and make sure everything balances. So if you don't know debits and credits, essentially think about it. Assets are going to increase with a positive number, and anything that's the other side, if you're decreasing an asset, it's going to be a negative number. If you're increasing a liability or equity, that's going to be a negative number. So that helps. So on the 15th, we're going to purchase some more equipment with a loan or purchase it on account. So purchase $1,500 of equipment with a loan of $1,500. Run our checksum. I'm just going to drag this to the bottom so it it's there for all the rest of my transactions. As you know, it should be 0, and it is. If it's not 0, that means I kind of messed something up, and I need to go back and figure out usually my negatives or positives are messed up. So now on the 20th, we're going to have another transaction. We're going to mow the Jones yard. So got our first job. We're going to start mowing. We are going to bill them, so it is going to be receivable for $50, and we're going to record our sales at 50. Now you'll notice I didn't put the negative in, so a checksum is wrong. So sales are coming as a negative because we have a receivable, which is an asset, as a positive. So our credit to sales is a negative. Once I get that fixed, it zeroes out that checksum. Now, that happened on the 20th. Let's see, what else do I want to do? So what I'm going to do, I'm going to end up with a bunch of receivables as I mow yards or do work for other people. So over here on the side, I'm just going to record my different receivable accounts. So for instance, Jones is its own separate thing. I could have put this much detail in the main ledger, but if you end up with 15 or 20 different accounts, that can get pretty overwhelming. So we're going to put it off to the side here, and it'll make sense how we use that here in a second. So now on April 20th, as you can tell, I messed up the date because I didn't put the year in. So put the year in, fix the date. Now we're going to collect the Jones bill. Again, that was $50 of receivable, so that's going to go away. They now paid us, and we got $50 in cash. So you see that all balanced out. I now go over here to my Jones receivable, show that the Jones receivable paid. So Jones now owes nothing. Now moving on, let's say April 27th, I'm going to mow the Jones yard again for $50. So there's my receivable when I bill them, or they haven't paid me yet. Again, I get my sales of $50, which is entered as a negative because it's a credit, or it's the other side of an asset. And then let's go down here on April 30th. I'm going to mow, let's say, the Smith's yard. So I mow the Smith's yard. Oh, look at that. I forgot to put the $50 in the Jones receivable. So I went back and did that. Now, I mowed the Smith's yard for $50 as well. I enter my $50 receivable, my sale, and then I add a column to receivable, kind of what we call a subledger if you were accounting knowledge, but the subledger for the Smith is now was $50. And then again on the 30th, I'm going to purchase some gas and other supplies. So purchase gas. Oh, look, I misspelled purchase equipment. Fix that. Okay, go back. Purchase gas and other supplies for $35. So I have $35 less cash, and we're going to put that under, let's see, put that under other expenses. So at $35 of other expenses, that's a positive because it's an expense, because cash is a negative. So I'm going to wrap that up. So that's going to be my first one. Very few transactions. We have, 7 transactions here. So I'm going to do kind of before adjustments total. Depending on how you're doing your business, you might not need anything other than this amount per period. So before adjustments, I'm just going to go and sum up all of my columns. That gives me the total in each column. Now I'm going to make some adjustments. These adjustments, these are things that didn't have a specific transaction for, but still need to get recorded correctly in the financial statements. So these are all going to happen on April 30th, the end of the month, basically. It's kind of adjustments for the end of the month. So I'm going to depreciate my equipment. I am recording equipment as equipment, not just expensing it. So I'm going to depreciate that over time. Let's assume that my equipment has, let's see, I have $2,500 worth of equipment. Let's assume that that equipment is going to be around for, 4 years. So 48 months, because I'm doing this on a monthly basis. And that gives me my depreciation for the year. I'm going to multiply it by -1 just to give me a negative number. So roughly $52. So $52 is going to be my depreciation. That is going to be an expense to me. So I've used up $58 or $52 worth of my equipment. So they're now worth $52 less. That's the general idea this month. Put that in as an expense. The expense needs to be a positive because I'm decreasing an asset, which is negative, increasing expense, which is a positive or a debit in accounting lingo. Some other things I'm going to do. A note, remember, I have a loan. So on my loan is going to have interest expense that I haven't paid yet. So I don't know what the terms are on the loan, but we're going to assume it has some interest expense, which I haven't paid. So I'm going to make an adjustment for the interest expense. Again, if you're just doing a pure cash system, you wouldn't need to put a lot of these adjustments in there. I would still recommend doing depreciation, but the interest expense, if you're just doing a pure cash system, trying to track the money, just record it when you pay it. So there's our equipment loan. for $12. That is an expense. So it increases the amount of the loan and it creates an expense. So my final month-end totals, just do another sum of those amounts. Now, I kind of, I left the formula in the equipment. So we're going to actually see that it's, okay, it's $52. We'll just put $52 and leave it as that. That'll get us close enough. Format everything for kind of dollars and cents. It just cleans it up and makes it look nice. So there are my month-end totals. Cash of $515, receivables of $100. And now these are my closing entries. So those are my month-end totals, but notice I have $150 worth of sales and $99 worth of expenses. We're going to close those out, which means I had, that is my net income for the period. So I take sales and other expenses, I record the opposite as what's in there, that makes them 0. So my closing balances here should, for my assets and liabilities, should be the same except for equity, which should go up because I made money this period. And then my sales and expenses should go away. Misrecorded sales of $140 or $150, that fixed it. And now my equity needs to go up to $51. Okay, $51 of basically income to me this month. And that gives me where I can start again. So my closing balances of cash, receivables, equipment, and everything else. So that's what's going to transfer to the next month, and then I'll start again so I can keep my revenues and expenses going. Go over here, bring down my receivables, and then what I'm going to do, this is my transactions, I'm going to actually relabel this to April. Now I'm doing it by month. You could just as easily do this by quarter or year. If you have very few transactions, just doing this yearly is going to be sufficient. You don't need to go in and create new tabs. But if you're in like the 200 transactions a month, you will probably want to have a separate tab for each month. If you only have, say, 200 transactions in a year, it doesn't make any sense. Just run it by the year, record it as you go. You'll have your year-end totals, and then create a new tab for the next year. So I've now created a tab for May. I'm going to take my closing balances from April, and those are going to be my beginning balances in May. So copy those, put them up in the first row. All I did was copy the whole April tab over to May, and now I'm moving my closing balances up to the start, calling them opening balances instead, and now I'm going to delete all the April stuff. So right-click, clear contents for all the April stuff. One thing to keep in mind, when I pasted the closing opening balances, I did a paste special and then pasted just the values. Otherwise, you paste the formula, and the formula is wrong because it's pulling from weird cells or errors out. So these are, you just click paste special and then paste values, and that gives you the actual numbers instead of the formula, which is the sum of the lines above. So our closing balances now become our opening balances for May, and we'll just repeat the same process and do it again. Okay, so what I'm going to do now is, this is somewhat optional, but if you're looking to kind of create some reports, we're going to create some reports. So what I'm going to do, go up to window in your menu, select new window, and what it does is it brings up another window for the same book. So I created another sheet, and now I'm going to pull up April there, and then I'm going to create financial statements on the third sheet. So let's rename this. We'll name it financial statements. So let's name financial statements. Typically, you would start with the name of your company. I don't have one, so we'll start with balance sheet for the April 30th of 2020. That's the period date. Excel format, definitely, but I'm not going to mess with that for right now. Now, let's clean this up. So our assets are cash of $515. I'm pulling off of the April worksheet. And then I have receivables of $100. And then I have no inventory, so I'll skip that. Put equipment. My equipment is worth $2,448. And that's my last asset. Now I'm just going to have total assets, and then equals sum, open parentheses, and just select the cells you want, close parentheses, and enter. So I have total assets of $3,063. I'm going to clean up some of this formatting. I'll do liabilities next and equity. So we have one liability, our equipment loan. Equipment loan is, with the new interest added to it, it's $1,551. And then we have our equity, which is, equipment loan is $1,512, and then equity is $1,551. Get that fixed. And my total liabilities and equity is just the sum equals sum, sum those two numbers up, close parentheses, my total liabilities is $3,062. So it equals my total assets, which it should. If it doesn't, I mess something up. That's what the checksum was supposed to help you with. Now we can also do an income statement. Same thing, income statement. Income statements are actually for the period ending, or the month ending April 30th. I'll just type in April 30th for simplicity, but that should be clarified typically. Now I have sales, and then I didn't have any maintenance expenses, but then I have other expenses. So I'll just put in as expenses. Sales for the period was $150. I'm getting this from basically the pre-closing amounts. Expenses were $99. Therefore, my net income for the period was sales equals sales minus expenses was $51. So there's my balance sheet and income statement for the month of April. Do some quick formatting here just to kind of make it a little bit cleaner. Right click, merge. We're going to merge across. Oh, it's not an option for right clicking. Oh, there, I have a button in my home menu. Merge across the cell. That just spreads it out over the whole period. Do the same thing for the income statement and date for those. Now, I'm going to shrink down these cells were just added in for spacing. So I'm going to shrink them down just to improve formatting a little bit. There we go. Now it doesn't look like they're hanging out in the middle of nowhere. And now I'm going to format these with a line above and two lines below. So single top, double bottom, which it means that's the sum. So I have my total assets, total liabilities and equity. Do that for net income as well. And that gives me not a bad looking income statement. I can bold assets and liabilities. Give it a nice little look. Oh, there's nothing in the income statement. Okay, there is an income statement. Doesn't look terrible. If you have more accounts, obviously you'll have a little bit more extensive. And that's what it looks like. So now if we wanted to add another month, we can just highlight these and drag them over. I couldn't highlight the whole thing because I have those merge cells. And then we're going to call this as April. And let's say we wanted to add a column for May. If you were doing this by year, you would just say 2019, and then we add 2020 next to it. A lot of times for just startups, you don't have to do this by month. That's generally kind of a waste of your time. You can pull the totals without it. So I have April and May now, and then merge these across the whole area just to clean it up, make it look a little bit nicer. And that will pretty much give me my balance sheet income statement for my very small startup company, at least for May. So there we have it, April, May. Financial statements, just add a tab every month and adjust your financial statements as you need to have them submitted, say, to a bank or other interested parties or yourself if you're interested in just having something pretty. So there it is. That's what it looks like, all kind of laid out there. There's a number of tweaks you can make to this, add columns, add rows. If you want, you can leave a sum row at the bottom, which allows you to, at any point in time, know how things are doing. So you can go back here and format it a little bit just to help delineate some things. And you can expand this very extensively. I would say until you hit probably 150 or 200 transactions a month, unless you need other functionality in the out-of-the-box systems like Quicken or some of those others, this is probably just going to help you just as much as those would be in terms of making decisions. So, as I just mentioned, we'll go in here in May and we'll do sums for the column. And that way, as we enter our transactions, we'll actually be able to see what our balances are at that point in time. So drag them all over. Our starting balances are the ending balances for the time being. But then if we went in and entered transactions, like say collect from the Joneses, the $50 they owe. So there's the $50 we got, take it out of receivables. You can see it updates those. It updates that total at the bottom. So now I know I should have $565 of cash and $50 of receivables. And that'll update every time I add a transaction now. Well, that pretty much wraps it up. Hopefully you found that helpful. Again, it's a good, easy system for a startup company until you're ready to bite the bullet and want to put the time into setting up a full out-of-the-box system. Now, out-of-the-box system adds things such as billing capabilities. You can create invoices, things like that. A lot of times you don't need that when you're first starting up, but if it's something you need right out of the gate, you might consider those packages right from the start. Otherwise, you can give Excel a shot until you're willing to spend the money for something more comprehensive. With that, have a good day and God bless.